Most people think of the tax code as just a set of rules for paying the government. But what if it was something more? What if it was a blueprint, an entire architectural system designed to guide your financial decisions? Well, in this explainer, we're going to break down that architecture, focusing on the powerful mechanics behind real estate and business structuring. So this is the big question we're tackling, right? How can real estate paper losses legally slash the tax bill from your main job? And I get it, it sounds almost too good to be true. But it's a fundamental feature that's built right into the tax code. We're going to dissect the core mechanisms step by step to show you exactly how it works. Okay, here's our game plan for today. We'll start with the why, the core incentives built right into the tax code. Then we'll dive into the engine that drives this whole thing, the paper loss. After that, we'll look at how you can actually connect those losses to your main income. And finally, we'll cover the business structures that protect and optimize the entire strategy. All right, to really get this, you have to start with a pretty big shift in how you think about taxes. See, the tax code isn't just about collecting revenue. It's actually a super powerful system of incentives designed to steer economic behavior. And this quote right here, it really says it all. What experts are telling us is that the government actively uses tax breaks to motivate people to do certain things, activities that are seen as a benefit to the country. It's less of a command and more of a massive reward system for playing the game. And this is a perfect example. Think about it. The government needs housing for its citizens, but instead of building it all themselves, which would be a monumental task, they incentivize private investors to do it. So investors provide the housing, and in return, the government gives them some really significant tax advantages. It's a win-win-win for the government, the investor, and of course, the tenants. Okay, so we've covered the why, the incentives. Now let's get into the how, and that brings us to depreciation. This is the engine, the real engine at the heart of this strategy that lets you create these things called paper losses. So what is it? Well, the IRS lets you take an annual tax deduction to recover the cost of your investment property over its so-called useful life. The most important thing to understand is that this is a paper expense. You're not actually spending this money each year. You get to claim a loss on your taxes even while your property's actual market value might be going up. It's a wild concept. Now, the standard way to do this is, pretty slow. For residential property, you're spreading that deduction out over 27.5 years. But there's a much faster way. It's called accelerated depreciation, and it lets you cram a huge portion of those deductions into the first few years you own the property, creating a much bigger loss up front. So how do you unlock that acceleration? The key is something called a cost segregation study. This is basically a super detailed engineering-based analysis that breaks a property down into all its little components. We're talking carpeting, appliances, light fixtures, you name it. Those things have a much shorter useful life than the building structure, which means you can depreciate them and write them off way faster. All right, so you've done a cost seg study, and now you've got this massive paper loss. That's great, but it's only half the battle. The real magic, the ultimate goal, is when you can connect that loss to your main income, from your W-2 job or another business, and use it to reduce your active income tax bill. But of course, there's a hurdle. There's always a hurdle, right? By default, the IRS considers rental losses to be passive. This means you can typically only use those losses to cancel out other passive income, like from another rental property. They're basically kept in their own little box, separate from your main income. So the big question is, how do you break out of that box? How do you get past that limitation? Well, believe it or not, the tax code itself gives you a couple of keys to unlock that door. There are two very specific paths you can take to legally reclassify those losses from passive to active and unleash their full power. And here they are, your two main gateways. First, you can qualify as a real estate professional, or REPS. Now this one's a big-time commitment, requiring over 750 hours a year and more than half your working time.
The second option, which is often much more accessible, is the short-term rental strategy. Think Airbnb. This one relies on the nature of the rental and your material participation. Basically, you have to be hands-on with managing it yourself. Now, this brings us to a real game changer for couples, often called the spouse strategy. If you file your taxes jointly, only one of you has to meet those strict reps time requirements. This means a high-earning professional, say a doctor, can have their spouse qualify as the real estate pro. If they do, boom! The couple can then use all the paper losses from their properties to slash the taxes on the doctor's high income. It's an unbelievably effective strategy. Finally, let's talk about the foundation that holds all of this together. Because having the right legal structure is absolutely crucial. Not just for tax optimization, but for protecting your personal assets from any business liabilities. Your first line of defense here is the LLC, or limited liability company. It essentially builds a legal wall between your personal assets, like your home and savings, and your business liabilities. Now here's a huge tip from the experts. You want to set up the LLC before you buy the property. Why? Because trying to transfer a property into an LLC later can potentially trigger a due on sale clause in your mortgage. And trust me, that is a massive headache you want to avoid. Okay, shifting gears a bit. For those of you with a separate, profitable business, the structure you start with isn't always the best one as you grow. As your income goes up, your tax needs change, which raises a really important question. When is it time to evolve your tax structure? Well, according to tax professionals, this number, right around $50,000 in annual business profit, is a key trigger point. It's the approximate threshold where the tax savings from switching your LLC's tax election to an S-corporation often start to seriously outweigh the extra costs and complexity. So why even make that switch? It all comes down to one thing: managing the 15.3% self-employment tax. For a standard LLC, every single dollar of profit gets hit with this tax. As your business gets more profitable, this becomes a significant financial drag. The S-corp is designed to fix this problem directly. And this illustrates the difference perfectly. With an S-corp election, you split your income. You pay yourself a reasonable salary, which is subject to payroll taxes. That's pretty much the same as self-employment tax. But, and this is the key, any profit above that salary can be taken as a distribution, which is not subject to that 15.3% tax. This strategic income split is the core of the S-corp savings strategy. This all brings us to a final powerful thought. Once you understand these mechanics, the incentives, the depreciation engine, the income offsets, and the legal structures, your entire perspective can shift. Your tax return transforms from just being a record of compliance into a forward-looking tool for strategy, built on the very architecture of the code itself.